Welcome to Weekly Review of the U.S. Economy. I am Glenford Robinson. Why did the Federal Reserve injected $88.1 billion in the U.S. economy this past Thursday? Let's find out. Let's see how well our economy did in the past week from the last time we published our weekly review on the U.S. economy. We shall proceed in chronological order from first to last. On Tuesday, October 8, 2019, at 8:30 a.m., the U.S. Bureau of Labor Statistics and Department of Labor released the Producer Price Index, PPI. The Producer Price Index measures the change in the price of goods sold by manufacturers and thus functions as a leading indicator of consumer price inflation, which accounts for the majority of overall inflation. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. The PPI reading gives us some degree of predictive insights on inflation rates well before inflation data becomes available. As we can see in the PPI report, month over month, for September, the reading of negative 0.3% came in well below forecast of 0.1% and a previous reading of 0.1%. The current reading of the PPI suggests inflation rate could be exhibiting downward pressures, a telltale sign that the economy has slowed down and will need monetary stimulation from the Federal Reserve. Now that we have reviewed the PPI report and pointed out that it predicts the inflation rate to some degree, we will now go over the inflation indicator itself, and that is the Consumer Price Index, CPI. We will talk about the Core Consumer Price Index right now. The core CPI measures changes in price of goods and services, excluding food and energy. The CPI measures changes in prices in regards to the consumer and measures changes in consumer purchasing trends and inflation. A higher than expected reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. Let us now go over the current reading of the core CPI report released by the U.S. Bureau of Labor Statistics on Thursday, October 10th, 2019 at 8:30 a.m. Eastern Standard Time. The current core CPI reading of 0.1% missed forecast of 0.2% and a previous reading of 0.3%. This result suggests that the inflation rate declined by 0.1%. Readings such as this confirm that the U.S. economy has declined. Too few dollars chasing too many goods. In other words, there is a reduce of money supply in the U.S. economy. Wow. It seems as if we are now staring recession straight in the face. Oh my gosh, I'm scared. Let's see what the Federal Reserve has done about this. Well, on Thursday, October 10th, 2019, the Federal Reserve Bank of New York added $88.1 billion in the U.S. economy to combat funding pressures in money markets, thereby using the market for purchase or repurchase agreements, or repo, and will add more money in coming weeks. When the U.S. economy needs a financial boost, the Federal Reserve provides money in the form of loans to central banks. The Fed added the $88.1 billion to stimulate the economy because the U.S. economy has begun to slow down dramatically. And the core CPI result of 0.1% showed this by coming in below forecast of 0.2%. well below the previous reading of 0.3%. The Fed accepted requests from banks for $45.5 billion in overnight reserves in return for collateral in the form of Treasury and mortgage securities. In a separate operation, the Fed accepted another request from banks totaling $42.6 billion in 14-day loans. The bank will once again offer collateral in the form of Treasury and mortgage securities to the Federal Reserve in return for the money. The repo market provides the platform for borrowers and lenders to interact. When borrowers need cash from lenders, they offer collateral in the form of safe securities, such as Treasury bonds, in exchange for short-term loans from lenders. Loan terms can be as short as overnight. The Fed regulates the supply of money in the financial system by utilizing several means, and the repo market happens to be one of those means. The Federal Reserve takes on the role of a lender when it adds money to the financial system through the repo market. In the repo market, lenders can include money market mutual funds, banks, or hedge funds. These financial entities, embark on such transactions when seeking to earn higher interest rates than what is available from holding very short-term government securities. Banks, securities firms, and hedge funds borrow money to use as cash for financing positions in their respective investment market. Last month, a shortage of available cash in the financial system caused repo rates to rise as financial companies scramble for overnight funding, which subsequently led the Fed to begin offering repo loans. The Fed took such actions during the last financial crisis in 2008, which tells us that our economy could be revisiting such crisis again, especially if the trade war between China and the United States do not come to an end. The Federal Reserve said last week that it will extend its scheduled repo lending to November 4th. The Fed said it will continue offering overnight repo loans for at least $75 billion each night until November 4th. And after that, the available amount will drop to $35 billion through October 29. Let's see how the JOLTS job opening report did for August. Would anyone like to guess? Please be honest and put your response or responses in the comment area below the video. Okay, here we go. The current reading of the JOLTS job opening report for August released on Wednesday, October 9th, 2019 at 10 a.m. Eastern Standard Time came in well below the expected 7.191 million job openings, posting a disappointing reading of 7.051 million. Well below previous readings of 7.174 million job openings. The U.S. Bureau of Labor Statistics conducts the JOLTS job opening survey to help measure job vacancies. The survey collects data from employers about their businesses, employment, job openings, recruitment, hirees, and separations. On the last day of the month, the JOLTS job openings report defines all unfilled job positions. An open job position meets all three of the following conditions. 1. A specific position exists and there is work available for that position. 2. The job could start within 30 days whether or not the establishment finds a suitable candidate during that time. And 3. There is active recruiting for workers from outside the establishment location that has the opening. A higher than forecasted reading should be perceived as positive for the U.S. economy and bullish for the U.S. dollar, while a while a reading lower than forecast should be perceived as negative for the U.S. economy and bearish for the U.S. dollar. So, based on the current JOLTS job opening report for August, the economy continues to slow down month after month, confirmed by economic indicator after economic indicator. This smells like the cusp of a recession, pre-recession, or a full-blown recession. The numbers don't lie. Here come a commercial break before I finished. It goes as follows. Are you a successful forex trader or a successful stock trader and want to gain even more success as a trader? Well, look no further than the Mstardom Finance weekly review of the U.S. economy. The weekly review comes in a video format and an article format. The video format, hosted by Glenn Ford Robinson, can be seen on the Mstardom Finance YouTube channel, and the article format can be seen on the Mstardom Finance website at mstardom.com. For in-depth fundamental analysis of how to create a forex and stock trading strategy using the data presented in our videos and articles, please contact 631-747-7237. I am Glenn Ford Robinson. I will be back next week with another edition of Weekly Review of the U.S. Economy. Thank you and goodbye.